All right, welcome to the webinar here. We're going to be talking today about the capital stack structures. And as you can see on your screen there, we're going to be talking about the what is a capital stack, what are the different components that actually have seniority, which components have the most risk, and of course, which ones have the least amount of risk. And then we're going to talk about the two-tiered structure and a single-tiered structure of equity structure, so you can kind of see how those are laid out. And you'll see these with various operators on how they're actually putting projects together. And so you'll want to make sure that that you do that. So, and I know Bill is asking, William there is asking, do we have slides? I don't have slides yet. So these slides I'll bring up in just a moment as we get started to show you what these different capital stacks look like. So for those of you who don't know who I am, I'm one of the managing partners with a group called passiveinvesting.com. You can kind of see that on my hat right up here with our logo. If you go to passiveinvesting.com, and for those of you who are live, I'll type it into the chat box. So if you wanted to check us out, you could. I have a page there with my bio, as well as the other two managing partners that are in our group. And our group primarily acquires assets around the Carolinas. We do also have some in Texas and Tennessee, but right now, lately in the last probably 12 to 18 months, we've been pretty heavy here in the Carolinas. I'm located in Columbia, South Carolina, and our other managing partners are here in the Carolinas as well. And so if you're interested after watching this and kind of learning more about us, or possibly join our Passive Investor Club, go to that website, fill out your information. I'll jump on a phone call with you and have a one-on-one conversation with you to see what your investment goals are and to see if we're a good fit. The second thing I wanted to mention before we get started is the MFIN Summit. So it's a live 3-day online event about multifamily investing and the current state of the economy. And this next one that's coming up is going to be June 11th, 12th, and 13th. And you can go there to mfinsummit.com, mfinsummit.com, and register for the event. You can see the list of the speakers. We have some pretty well-known people on there. We got Dave Lindahl, kind of a long time, 20, 30-year veteran in the space of multifamily. Got some other really good people in here as well. And would love to have you join us at the event. So I'm not going to mention too much about this. I'll go ahead and move on to the topic, but I wanted to mention that to you. And if you're watching this and it's past June 11th, 12th, or 13th, we do not sell the recordings to the event, but you can register for the next event, which is coming up in January 2020. And so you can always go to mfinsummit.com to find out more information about the next summit that's coming up. So let's go ahead and get started here and talking about what is a capital stack. And so as I go through this, I want to share my screen with you with the different actual capital stack structure so you can actually see what this is. And I know somebody was asking here, was this going to be recorded and sent out? Yes, it is. So we are recording this, and it will be sent out to those of you who actually registered for this event, for the actual webinar here. So stay tuned for an email. We usually try to get it out the same day in the afternoon. If not, it'll be the very next day, but we do our best to kind of send them out as soon as possible so that you're not wondering where those recordings are. So let me share my screen here. This should be a different screen here. So go ahead and raise your hand if you can see my new screen that I've shared here, which is the capital stack, and you can kind of see how we've actually outlined it here. Okay, good. So you have a good number of people on here. Typically we have, a couple hundred people on these webinars, and we have that today as well, which is great and nice to see. This is a topic that I think is very important that a lot of people don't talk about, and it's what to understand as you're putting together different things. And I won't be sharing these slides, but again, the recording is going out. So there's only 3 slides. So there's just talking about the different equity stacks. I'm going to be talking through this mostly talking through it more than I am actually going from the slides. But this is just for you to have a visual as to what we're going to be talking about as we get started. So first off, let's talk about the capital stack itself and what does a capital stack what is it comprised of? And so as you can see on the screen here, and I'm going to see if I can get my annotation button here on so you guys can actually see the spotlight. So hopefully you guys can see this this red dot, if you will, that's on your screen. And let me see if I can make this thing any bigger. There we go. So can you guys see this red dot on your screen? Just say just raise your hand if you can actually see it. Just raise your hand. And it sounds like somebody says that they cannot hear me. Can everybody hear me okay? I just want to make sure it's not just if it's me or if it's somebody else, if it's just their mic. So if you can hear me in the chat box, just type in yes, I can hear you, just so I know. Usually we're doing okay. Okay, so everybody else seems to be hearing us just fine. So it might be on your end, Ronald, that you might be having some issues as far as the sound is concerned. And they can also see the dot here on the screen. So that's perfect. So I want to outline a couple of things for you that you'll normally see. There's really kind of four components. There's usually four components of a capital stack, okay? And a capital stack actually starts at the bottom down here and it's built up, just like you were stacking up just like you were stacking up like Legos, if you will. So you can kind of think of these as Lego blocks for a little bit, right? And these Lego blocks are going to, again, you're going to start by putting that first Lego block at the bottom, and that first one at the bottom is typically going to be the senior debt, right? This is going to be your main lender, who is typically your largest investor. Now, they're not technically an investor, but they kind of are, right? They're just a debt investor. And so they're going to be doing the most checks and making sure that they're reviewing a lot of due diligence a lot closer than just about any of these other capital stacks or components of the capital stack. There's four main components that you'll see in the multifamily investing realm. You're going to have this senior debt position, right, which is going to be your main lender. Right on top of that, it's going to be what's any type of mezzanine debt, or you might even consider or think of this as maybe a secondary loan, or there might also be really it's kind of like a supplemental loan, if you will, what you might see there, or some sort of mezzanine debt that you might see. And the mezzanine debt you don't normally see very often in our multifamily stack structures. I'm going to show you the two most common ones that we use in our group, passiveinvesting.com, so you can kind of see how we structure our deals and how the capital stack is actually laid out. But then most of the deals that you'll see with us, you're going to see these preferred equity positions, and then you'll see a common equity position. Now, there's a couple of things that I want to mention here where you'll see over on the left-hand side, it says risk, okay? So the higher in the capital stack you are, the higher the risk you're going to have. So conversely, the lower you are in the capital stack, the lower risk you're going to have. Now, the returns are going to be commensurate with that level of risk. So obviously the senior debt position is going to have the lowest interest rate, which would be their quote unquote return, if you will, on that investment. And same thing when you come to any type of mezzanine debt or preferred debt, the interest rate is going to start going higher and higher and higher, right? Or maybe not interest rate. As we start to go into the equity position, the equity returns are going to start to go higher and higher and higher based on that risk. Now, the same thing with the priority position on the right-hand side here, you're going to see that as you go down the capital stack, you're going to have a higher and higher priority. So the senior debt position has the highest priority. The mezzanine debt has at the next level of priority. The preferred equity has the next, and of course you have your common equity. And what I mean by priority is that if you're at the lower you are in the capital stack, you're going to get paid your return first, right? And then also your initial capital will be returned back to you as well. And so, for example, when you sell a deal, when you sell a property after you've gone full cycle with it, the first thing that's going to happen is you're going to have the senior debt holder paid first. They're going to get paid out first, and that whole entire debt or that loan is going to get paid out first. If you have any other debt holders like mezzanine or supplemental loans or secondary financing or anything like that, they would be in this position, and they would then get paid after the main person. And then after all the debt's been paid, then you're going to start going into paying back some of the initial capital for the preferred equity piece, and then the returns for preferred equity, and then the common equity would get their return back first, and then their initial capital back as well. And I'll go over these two structures that we have, and if you have questions about them, I want you to certainly ask me if you have them, because you probably will have quite a few questions as I go through this, because there's so many different ways that these capital stack structures can be built out or laid out. But these are the four main positions that you will see. They can be structured multiple ways, and there can be more than just four, right? And you will see that, this will be a very common situation. But the biggest thing I want you to understand about this type of capital stack is that some of the nuances about where you are in the capital stack and why it's important to be in certain positions. And so, the biggest thing to point out is, again, the lower you are in the capital stack, the higher priority you have when you're getting paid. And same thing as the risk. The lower you are in the capital stack, the lower risk that you have. And that's because you're going to have that higher priority, right? And so the higher priority you are, the lower the risk you have in the investment itself. And typically the operator is going to have the highest risk because they're going to be in the lowest class within that common equity structure, which we're going to share with you and kind of show you here in just a moment. So I want you to raise your hand. Does that make sense to everybody, what I just explained? You probably have never, heard about this before or seen something laid out like this before, but does that make sense to you? So just raise your hand. Let me know that you're paying attention and that it actually all makes sense. Okay, good, good. So somebody else is asking here just real quick as you guys are raising your hands, letting me know that you're paying attention. Some investment decks and Excel's cell backends have a section called sources and uses of capital, and the capital stack would be synonymous with sources. Is that correct? It somewhat might be, but it'll be similar, but not exactly, because even in your sources and uses, you're going to have sources and uses is really where the funds are being placed, right? But you're going to have different closing costs and financing fees and lender fees and things like that in your sources and uses, which will not necessarily be inside of a capital stack itself. And so that you're going to be able to get equity from your investors to pay for that, but usually in sources and uses is where you're actually spending that money. Okay. All right. So let's see here. A couple of questions that have come in here. I'll just go ahead and address these as we're going through. So would the senior debt necessarily be the best spot to be in? It's not necessarily as to whether or not it's the best spot to be in, but it's the lowest risk. And so depending on your level of risk or your level of risk tolerance, then you might want to be in one versus the other. But typically, if you're in that senior debt position, you're going to have a lot deeper pockets because you're going to write a larger check. And so that larger check, and the reason why it's lowest risk is because if the deal falls through, the senior debt holder can actually take over the property, sell the property, and still make their money, right? And still get some money back. And so it's not necessarily that it's the best spot to be in, but it is the lowest risk to be in, because most of your investors are going to be in either a preferred equity position or a common equity position as well. Is common equity where the operator is? Yes, that is correct, Marianne. And we're going to go over a couple of structures here so you can kind of see exactly where each one of the LPs or limited partners or passive investors are, as well as the operator as well. Let's see. In terms of percentage and of value, what would be the amount of senior debt normally put in a deal? So that's going to be your loan to value, Omar. So depending on what type of debt structure you're putting on, it's going to be anywhere between probably 60 to 80% of the entire deal is going to be in that senior debt position. And of course, the lower amount of the lower the loan to value, the lower the risk for the senior debt holder. So you can usually get better terms like lower interest rate or more years of interest only and things like that. The lower you are as far as that loan to value. Have you mentioned yet the higher priority gets the lowest return? So we mentioned that a little bit earlier on, Brad, but it's a good thing to bring up because yes, the lower you are in that capital stack structure. So if you're down here in the senior debt position, you're going to be in the highest priority. So you're going to get the lowest return because the risk of that deal is a lot lower as well. Is it common that a lender takes a secondary position? No. So the lender is going to be the senior lender is going to always be in that primary, that first position at the bottom of the capital stack. But you might have a secondary lender that is in the second position. But your main lender, who is going to bring the bulk of the debt, is going to always want to be in that primary position or in the bottom of the capital stack, so they have that lowest risk in the overall deal. Do you use the term gap funding, and would that be the same as the preferred equity? So it could be both, Marianne, because you could actually for gap funding, you could either use a preferred equity type of provider, or you can use some form of another debt type position, whether it be mezzanine debt or a bridge loan or some sort of like smaller debt position to be able to do that. The risk is mitigated by how conservative the deal is. Now, that the risk is mitigated. Omar's bringing up a point here about the risk is mitigated by how conservative the deal is, but it's not necessarily that. It's not really. That's really more important for the equity holders, not the debt holders, right? Because the debt holders are really just concerned about, is the deal safe enough that they know they're going to get their equity back, not their equity, but the money back that they put in for debt, as well as the return that they're expecting. So they're going to be really closely looking at that debt to service income ratio to make sure that you actually meet those as well. Let's see. Can you explain both equities further? So yes, we're going to go into those different structures here in just a moment, Cole. So let's, I have a couple more questions that are coming here. If we have time, Bobby, I'll explain the preferred returns. I know some people aren't familiar with the words preferred return, but I'll go over theirs. I'll go over theirs a little bit if I have time. Can you give me an idea of what a typical percentage return is for each of the stacks? So yeah, so typically you're going to be in your senior debt position. Like right now, interest rates are going to be about 3.5 to about 4% for a primary senior debt agency type financing right now. Your mezzanine debt is going to probably be somewhere in about probably like the 5 to 6% range. And of course, preferred equity position is going to be a little bit different because the returns on a preferred equity position is going to be anywhere between about I'd probably say 9 to about 12 or 13% because it's going to be a lower risk investment and smaller portion of the capital stack. And then the common equity is going to be the one that's going to have your highest return because again, it's going to have that higher risk as well. How much has spread of interest rates from top to bottom changed in the last 3 months? So as far as the spreads are concerned, really kind of your primary lenders over the last couple of months is going to be Fannie Mae and Freddie Mac because of the whole COVID-19 pandemic. A lot of your lenders your secondary lenders or your non-traditional lenders have kind of dried up or pulled back. I mean, April's been a little bit better. I think into May, we're going to start seeing some of those lenders come back, but I think they're going to increase their spreads. But even right now with Fannie Mae and Freddie Mac, they are still competing for that business. And so we're still seeing interest rates. I've seen one recently that was at 3.27% interest. We just refinanced one of our properties at I don't know, I think it was like 3.37 or something like that. And we have another property that's closing next month that we're hoping to get pretty close to that as well. So the spreads have increased a little bit, but I think you're going to start seeing some of that come down as more lenders are starting to come in as well. How does supplemental loans for Fannie and Freddie work? So it depends on the type of structure you have. If it's a small balance loan, so it's under 5 million, typically it's harder to put a supplemental loan on there. You do have to ask permission from the primary debt holder in order to get a supplemental loan. But Fannie Mae is usually a little bit more open to that than Freddie is when it comes to the small balance. If you're not in their small balance program, then they're usually a little bit more flexible with that, as long as the debt to service income ratio is there as well, and they can make sure that they're being paid too. Okay. Let's see. For the MFI and Summit, there are a few events overlapping each other, and I'm interested in both. Will the ticket have access to both after the recording? So I'm not really sure. Oh, you mean as far as each one of the sessions? So there's actually two different, what this person's referring to. Thanks for bringing this up, Nicholas. There are two different rooms in each one of at the MFI and Summit. So if you go to the MFIandSummit.com page, you'll see we have the schedule listed there at the bottom, and there'll be room 1, room 2. And so there might be, two different topics going on at the same time. And yes, both sessions, whether you attend the session or not, all of the sessions are going to be recorded. And so if you miss one, you could always go back to that session later on and watch the recording because you will have access to all of the recordings at the summit. Charles is asking about the loan assumption versus the supplemental. So yes, both of them are typically you're able to do some form of loan assumption. They are a little bit more strict on who they actually will allow to assume those notes, but there's also a lot of other nuances that go involved with that as well. So what are the most likely sources of mezzanine debt? So there's a lot of private lenders that are out there that do mezzanine debt. So you can do local banks, you can do local investors that actually do mezzanine style debt with it. And a lot of times they'll want to have just a preferred equity position instead of debt, but it just depends on their particular situation and what they like to do and taxes and all of that. There's a lot of different nuances and moving pieces and parts to it. The best places to kind of find mezzanine debt is to work with a debt broker that can help you find that information as well. So let's go ahead and move on. I know you have a lot of questions, and there'll probably be some more questions as we move forward. I want to make sure we stay on track with making sure we go over these other two structures. So this next screen here is going to be what's called a single tier equity structure. Okay. And so this is going to be, you'll see there's no mezzanine debt here, and there'll be no mezzanine debt in our next structure either. This is a single tier. So you have this senior debt position. That's going to be your lender. It's going to be about 70 to 80% of the loan, not of the loan, but of the actual value. So the 70 to 80% loan to value. And then right above that in the capital stack is going to be your common equity. We have what's called common equity class A. So these common equity class A positions are going to be where they're going to get, they're going to be your passive investors, if you will. So this is where you have only two, it's a single tier, meaning that for your passive investors, there's only one class of share that they can invest in. That's the common equity class A, right? That's in this kind of dark blue section. The common equity class B here is gonna be the operator. So the GP portion. So this is gonna be 30. In our deals, we do 70-30 splits. So 70% is gonna be here for the class A investors, and then class B is gonna be given to the sponsorship team for structuring the deal and putting it together and all that kind of stuff. And so you can see that here, that the class A position for these investors is right next to the senior debt. So after that senior debt is paid off and we sell the asset, immediately class A gets paid. And then if there's anything left over, class B gets paid. And so this is going to be a very common position. And again, let's go back to our risk profiles, right? So the lower you are in the capital stack structure, the lower the risk you have, and the higher you are in the capital stack, the higher the risk you're going to have. And so you can see the senior debt position is going to be in the lowest risk position. And the next level of risk is going to be class A. And then your class B, which is going to be your operator, your GP percentage, is going to be in the highest risk category, because it's possible that you might only be able to pay your class A's and not have enough for you, depending on how it's actually structured and set up. Same thing with this. On the right side, you see our priority. So the lower you are in the capital stack, sorry about that. The lower you are in the capital stack, the higher the priority that you're going to have, okay? All right, so hopefully that makes sense to you. This is gonna be one of those ones where in class A on our deals is gonna be, gonna have some sort of like 7 or 8% preferred return. And then you might see that 70-30 split for everything after that. And typical returns, depending on the deal, might be between about, 12 or 13% IRR, internal rate of return, or a 16 to 17% annualized return, upwards to about a if you're talking about an IRR basis, about a 15, 16%, maybe 17% on an IRR basis on a 5 to 7 year hold, and then on a annualized basis, upwards to about 18, 19, 20%. How many of you on here know what a preferred return, or let me ask you this. How many of you do not know what a preferred return is? No, don't be shy. Don't be shy. Nobody can see it but me, but just raise your hand and tell me, say, hey, I'm not really sure what a preferred return is. I've heard of it before, but I don't really have a full grasp on what a preferred return is, because I want to make sure I can explain that to you. Good. I have about 10 to 15% of you on here that are not really 100% sure what that preferred return is. So the preferred return is going to be a return that is given to the investors, the limited partners, as it's a preferred return, meaning that you're going to get preferential treatment. You're going to get 100% of the cash flows up to that preferred return before there's any type of split, like that 70-30%. Right. And then when you sell the asset, same thing. You're going to get 100% of those sale proceeds to make sure that you get that preferred return. And then anything else after that preferred return is split 70-30. So technically the split is actually less than the 70-30, because if you include it on the overall deal, because the investors are getting the first 7% of the deal, they're going to get that preferential treatment. They're going to get those extra returns. And so for me as a passive investor, because I'm personally invested in 21, getting ready to be 22 different passive investment deals with 8 different operators, I look for those preferred returns. It's one of the things I want to make sure that I have, so I can have that alignment of interest, because I know as an active operator that I couldn't do these deals if I didn't have our passive investors. So I want to make sure I take care of and I protect my passive investors as much as I can. So I don't want them to invest in one deal. I want them to invest in multiple deals over decades and decades. As I grow my wealth, I want to grow their wealth at the same time. And in order to do that, you have to make sure that you take care of your investors. And so I want to make sure that they get that preferred return. And as a passive investor myself, I want those preferred returns as well. So that's really kind of what that preferred return is, right? And I see John has a question here. In today's market, are those IRR numbers realistic? I've seen more operators lowering their targets to 12% IRR. Your thoughts? I would say it depends, John, on the asset class and the actual business plan. So if you're looking at a lower end, B and C class property, I think you could probably get a little bit higher IRR. but our group primarily looks for really a solid assets that have lower risk than those. So we're looking at B plus value add assets, early to mid 2000s products, and then some A class products that are about 5 to 10 years old. And so we're going to start to see some numbers going down to that, 11, 12, 13% because we're in those higher end assets right now. But right now it's very hard to make for a lot of assumptions, and we're going to have to start seeing some discounts on properties in order to make these numbers work. And so I know a lot of people, we were actually just on a phone call, our group today, with a large multifamily operator that has $1 billion in assets under management. They actually reached out to us and said, "Hey, would you mind jumping on a phone call, sharing your thoughts on your portfolio and the status of your portfolio versus ours, and kind of getting and they're more of an institutional class. They use their own money to acquire those assets, and we're able to kind of compare our portfolios. And they actually had 4 assets that they had slated to sell this year, and they've decided to pull those back right now because of some of the unknowns and uncertainty, and they weren't forced to sell, right? So they're going to be pulling back. I think you're going to see a lot more deal flow coming out in 2021 as the market starts to shift and as the market starts to recover. All right, so let's look at this second tiered structure, this last structure here called the dual tier equity structure, and then I'll open it up to some of the questions that I already see coming in here, and we'll go from there. So this is another position that we've started using, another kind of capital stack that we've started using called the dual tier. Now, the reason why it's a 2-tier, and same thing on this other one, it says single tier. It looks like there's 3, right? Well, we're talking really primarily about the single tier equity structure for your investors. And so these single tiers are going to be in this common equity class A. The dual tier is going to be either your investors will either be able to be in this preferred equity position in class A or common equity in class B, right? Then of course, as the operator, you will have this other sliver up here, which is class C in this position, which is going to be still in a common equity position, but it'll be in class C at the top of the capital stack. So it'll have the highest risk and the lowest priority. And so your investors will either choose to be in class A or class B. Class A is usually going to have no participation in the upside, usually about 9 or 10% preferred return, and then no participation in the upside. And the reason why there's no participation in the upside is because you're in that preferred equity position. So you actually have lower risk because you're right next to the senior debt position. And that is usually only about 20 to maybe 35% of the capital stack. So the fewer amount of shares that there are available in that preferred equity position, the lower the risk it is for that class A investor, because there's only a smaller portion of that class A that needs to get filled up before class B starts getting paid. So I kind of like to have like a blended approach, if you will, when I'm investing in these types of assets, where I might put like 50% in class B, 50% in class A. If you're really diligent about it, class A, because it's the lowest risk, you could potentially make some pretty decent money there, even though it's only like a 9 or 10% preferred return, because as long as you are reinvesting that money, you can reinvest that money faster to get some really good returns, and you're in that lower risk position versus the class B. But it really just depends on how diligent you are with reinvesting your capital and whether or not you want to have participation with the upside. So common equity class B would also have a preferred return, usually 7 or 8%, but then they would also have participation with the upside. And then of course you have your common equity position class C, which is going to be your operator in that operator position. All right, so let me open it up for some questions here. I see quite a few coming in, and I'm going to go to the Q&A box first, and then I will go back to the chat box to look at some of those questions. All right. Is Class B considered the GPs? So Class B, I'm assuming there was a question that came in during this one. Class B is going to be, yes, the operator or the GPs. So good point there. In this position, the dual tier is going to be this Class C. It's going to be that common equity position, be Class C. With regard to the preferred returns, how does one assure the operator does not cannibalize the funds that should go to CapEx? Well, I think there's a couple of things there. You want to make sure that you're getting at least some quarterly financials to kind of see where those funds are being spent, right? And how does one assure the operator does not cannibalize the funds that should go to CapEx? Well, I mean, I think it depends on the operator. I mean, you have to ask that operator how they're using those funds. I certainly wouldn't want somebody to be giving out preferred returns and pulling it from CapEx funds, right? I think that's really the main thing that you're asking there is that the ability, is that what you're trying to do is give me back my give me a preferred return and pull it out of CapEx dollars. You definitely don't want to be doing that. Let's see. How common is it for deals that have a pref to also have a catch-up provision for the GPs? It's fairly common, Drew, and I've seen it quite a bit. It sometimes is a lot harder to make the numbers work because when you do a true catch-up, I mean, you got to have a lot of extra upside on that deal. And we've actually looked at it recently on a couple of our deals, and the deals just don't produce the returns that they're going to give to the investors and able to do those catch-up provisions. So giving the preferred return actually helps those investors and also helps the deal itself to be able to achieve the returns that you're projecting. But when you do a catch up, and for those of you who don't know what that is, it's basically it's allowing the GP to catch up to where the investor is with that 70-30 split. Usually whenever they sell the deal, sometimes they can do it annually, but usually it's when you sell the deal when there's a lot more proceeds available, you can go in there and do that catch up. So we actually have it on some of our deals, Drew, where we do have that catch up provision, but it's at the end of the day, we may not be able to do it because if there's not enough money to return to our investors what we originally projected, then we're not going to take that catch up. We want to make sure we're protecting our investors as much as possible when it comes to that. Let's see. So what type of deals are you seeing, a single tier structure versus a dual tier structure? So Cole, there's really an easy answer here. So if the deal has a lot of extra cash flows, but it doesn't have as good of a return, that's really when you want to jump in and maybe try to look at it from a dual tier equity structure, because as you put in this dual tier structure, what's going to happen is the Class A investor in here is going to take off and siphon off some more of the cash flows, but because they're not taking participation in the upside, it's going to juice the IRR, the overall returns for those Class B investors. And so it's one of those questions where if you have enough cash flows in the deal, that you can actually pull some cash flows from the Class B investors to give that extra cash flows to Class A during the hold period, then the Class B might have a little bit lower cash yield during the hold, but they're going to have a lot higher upside whenever you sell the deal because Class A is giving up the portion of those proceeds. Let's see, is this structure hard for the underwriter to determine return to present to the passive investors? No, it's not. John, one of the easiest ways to actually come up with this type of Class A versus Class B is actually to put it in most underwriting models or Excel spreadsheets, there will be a position for you to be able to determine what's called the mezzanine debt. And so you can pretend that this Class A investor is a mezzanine debt holder just for the sake of achieving those returns. Because if you're going to say Class A is capped at say 9 or 10%, you just put it in as a mezzanine debt for 9 or 10% because you're going to want to get that paid out. And it should be able to give you those same type of returns on those as well. So it's a pretty easy structure to be able to handle those. Does your IRR and ROI and preferred return calculations, and does your IRR and ROI and preferred returns calculations take into, I'm not sure, Steve, you might have to rewrite that question because I don't see the full question there. Does Class B in this tier structure get any preferred return? So yes, in this structure, they would get a preferred return. So in this dual tier, they're going to get a higher preferred return in Class A, usually 9 or 10%. In Class B, it's going to be a lower preferred return. It might be like, 7 or 8% in this Class B position. And they might not hit it year over year, but you want to make sure if you're investing in these types of deals that they have what's called a cumulative preferred return, which means if they don't hit that preferred return one year, it just rolls over to the next year. And then when you sell, it has not been fully realized, then when you sell, you'll actually be able to get caught up on those preferred returns as well so that you get that preferred treatment. So in your deals, if a preferred equity investor is given 8% pref return and then a 70-30 split, they also get that same percentage of capital gains upon sale. No, they don't get the same percentage on capital gains upon sale, but if for some reason they didn't hit that preferred return of 8% year over year, whatever is left to catch them up, we would make sure that we caught them up to that 8%. And so, and then that 70-30 split would be taken into account. Let's see. So Mike's asking a bit of a sidebar, but for dual structured deals, does the depreciation benefit vary between Class A and B, or is it solely based on the amount of investment relative to the total? So it's typically the same. So that say the treatment's the same based on the sharing ratio of the percentage ownership in the deal, which again is nice for some Class A investors because a Class A investor who wants really those tax depreciation benefits more than anything else, they can invest a certain amount of money and get the same benefit from depreciation versus the Class B investors at the same time, and they're bringing home more cash year over year as well. Do you invest in the New Jersey region too? So no, I do not. I try to stay away from the Northeast as well as on the West Coast, primarily here in Texas, Tennessee, Georgia, Florida, Carolinas. Those are our main areas that we like to kind of focus on. Does your IRR and ROI and preferred return calculations take into account taxes and depreciation? No, it does not. So it takes into account obviously property taxes, but I think you're more talking about like income taxes that you're gonna have to pay or not have to pay due to the depreciation. And it doesn't, because it's very hard to calculate that, because everybody's tax situation is going to be just a little bit different. So it's kind of hard to take that into account. But I will tell you that if you are truly being able to take advantage of these tax benefits of these types of deals, your returns are much greater in these types of investments. So an investment that, I'm in the top tier tax bracket. So if I'm able to realize and save a lot of money in taxes, these returns on these deals, instead of being a 15% IRR, are going to go to say 20, 25, 30% IRR because of some of the savings I'm going to have from the tax side of things as well. Basic question. Marianne's asking, what does IRR stand for? So the IRR stands for internal rate of return. And I'm going to post an article in here. I'm going to give you a link to an article that'll give you a better explanation as to what preferred returns are, so that you can have a better understanding as to what this is. So let me give you this link real quick for those of you who are on here. And for those of you who are watching this on the recording, you can go to passiveinvesting.com and go to our knowledge center on the top right-hand corner and just search for internal rate of return, or IRR. But you can certainly go there. There's the link right there that you can actually see. Looks like Melissa actually posted it there too, to all panelists. But I went ahead and did it, Melissa, to all panelists and attendees. So thanks for grabbing that IRR there. Remember that link. All right, so good question there about the IRR. No, we do not do new construction deals. Where's the best place to look for underwriting? Should we just go to bank to bank? Well, underwriting is going to be what you're going to do internally. So obviously the bank is going to do their own underwriting whenever you go to them to find a deal or to be able to obtain debt. But you're going to want to do your own internal underwriting or financial analysis is really what we're talking about when we talk about underwriting on each one of these deals that you're going to be putting under contract. What are some of the common equity percentages in each scenario in terms of cash flows? So as far as the cash flows are concerned, it's going to be based off those preferred returns. So Class A, if they're going to get a 9 or 10% preferred return, they're going to pretty much get that entire 9 or 10% out of the cash flows, depending on the deal, right? If it's a deal that's going to not pay out for the first couple of years, which is deals that I don't like getting in, but if that's the case, then obviously it's going to depend on the deal. But the types of deals that we try to put together in a structure, we want to make sure we can pay out that preferred Class A and then at least a portion of the Class B every single year if we can. It's kind of a hard question to answer, though, about what are the percentages in terms of cash flows, because every deal is going to be just a little bit different. Okay. Do you have to be a real estate professional to get the tax benefits? So to get the optimal tax benefits, yes, real estate professional status is definitely where you want to be, but you can still benefit from get some tax benefits from these deals, because the cash flows that you're making off the deals year over year can be offset by depreciation. And if you're not a real estate professional, the excess losses can help offset other types of gains that you might have in, say, the other income category or the other passive incomes that you have. Now, I'm not a tax professional. I'm not a tax advisor. So make sure you check with your CPA to get the proper advice on these different tax situations. But there is definitely a lot of benefits that you can have for these types of investments. All right, let's see. Got a couple of questions coming in here, several more questions. We have some extra time here. So let me go ahead and answer some of these questions. And looks like we have James Billings Kang asking, can you explain again in the dual tier equity structure, the distinction of preferential treatment between Class A and Class B? So the way these are going to actually work is going to be the Class A is going to get paid out first before Class B. So let's just say there's a preferred return here of, say, 9% in Class A. That Class A investor is going to get their 9% before Class B gets anything else, as far as the cash flows are concerned. So during the hold period, they're going to get that 9% first of the cash flows in Class A, and then in Class A, and then in Class B, if there's anything left over, they'll get that over and above after the Class A has been paid. And then same thing when you sell. The Class A is going to make sure that they get their 9% first if they haven't already been receiving that. And then Class A gets their return of initial capital first before Class B gets theirs. Now, hopefully there's plenty of money when you're selling it so that you get Class A and B and C gets theirs too. But if Class B doesn't get their initial capital back, it means that the Class C investor didn't get anything at all. And if Class A didn't get their initial capital back, that means Class B or C didn't get anything either, which is why it's very important to underwrite these things very carefully. And it also is one of the reasons why you get lower return for Class A, because you're in that preferential treatment position. On the tax side, are the profits from the sales always capital gains, or is there any instance where the IRS could view this as ordinary income from a real estate business? So typically, it's going to be, again, I'm not a tax professional. Make sure you get advice directly from a tax professional. But when you sell an asset, the profits from the sales are typically going to be either capital gains, or they're going to have what's called depreciation recapture, which is why you're going to want to try to do a 1031 exchange into your next asset whenever you sell that. So you can defer the depreciation recapture and also defer the capital gains. Those are the two main things that you want to be aware of when you're actually selling the asset. So Jack has a question here. Outside of the 8-pref and 70-30 split, what are normal acquisition fees and asset management fees charged by the GP in current times, if any? So typically, Jack, you're going to see acquisition fees of between about 1% to 3%. Normally, our group is around that 2% mark. And then the asset management fees are going to be in that same level, 1% to 3%. The biggest thing with the asset management fees that you have to be careful of is that some groups do it off of the overall equity amount, which actually has a lot higher asset management fees for them versus doing it off of the overall income of the asset. So our group does it off the overall income of the asset, and we're typically about that 2% mark as far as the asset management fees. Those are the typical fees that are charged in the current time. And a lot of it just depends on the total piece on this as well. Let's see here. So Dave is asking, is there a book that I would recommend for this? And let me see if I can actually give you a link to a book that might be able to help you as you're going through this. Let's see. One second here. I'll get you a link to a book that will help you. It's helped me quite a bit when I first got started, and pretty confident that it'll help you as well. One second here. Let's see. Sorry about this. Here we go. Let's see here. All right. All right. Almost got the link here. All right. Here it is. It's called, oh man, I pressed the wrong button. Let me go back here. Let's see if I can press the right button. So here's the link. It's actually a link called, it's a book called The Best Ever Apartment Syndication Book by Joe Fairless. And here's the link to it. And that way you can just copy and paste that link into your bar. It is an affiliate link. So if you buy it from that link, yes, I get like $1 or $2, but that book is a really fantastic book. Just like Brian just mentioned here, it's a very fantastic book. It has a lot of details on it, how these different structures work. Not necessarily just these structures, but apartment syndication in general, and making sure that you can become more familiar with this. So it's definitely a book that I would recommend. So I'll take maybe a couple more questions, and I know there's a lot more questions coming in that I'm able to get to. So, and again, I always apologize. I can't get to everybody's question, but we just want to make sure I stay on time and stuff like that as well. How do you suggest getting into your first deal? I think there's a couple of things. I think you should first start off as a passive investor first. That would be one of my first suggestions. That's what I did when I got started, to kind of understand the different nuances and see what it feels like to be on the passive investor side. And then trying to join another kind of co-GP or JV partner with another group to be able to build your credibility and experience and track record before trying to put on your own deal. And that's how I would suggest getting started in your first deal, is just trying to invest passively yourself first, and then doing it outside of that as well. Jared's asking, he came in late, will there be a recording available? Yes, we are recording this, and we'll send this out to everybody who registered so you can have access to the link to be able to watch it later. So as I'm going through the rest of these questions, you guys, has this been helpful for you? Is this stuff you've never heard before? I mean, has it been helpful? I want you to type it into the chat box and let me know if this has been helpful. And then also just raise your hand. Let me know on the screen. Raise your hand if you feel like this was helpful to kind of give you a little bit more expansive knowledge behind these different capital stack structures, because I don't really see a lot of people talking about this. And I feel like this would be a very good topic to kind of bring up. And it sounds like you guys obviously have a lot of different questions around these different capital stack structures as well, which is good for that too. And so somebody else was asking me about the name of that book again. It's called The Best Ever Apartment Syndication Book by Joe Fairless. And so there's a link to that book. I just typed it in there again if you wanted to do that as well. I want to thank each and every single one of you for being here. Thank you for being attentive. I really appreciate that. I think this has been the most attentive group I've had so far. And just don't forget, when you're done here, go to mfinsummit.com and register for the next summit. Would love to see you there. I promise you won't regret it. And I also want to give you my money back guarantee for that event. So it's an event that I'm not trying to make a bunch of money off of. My goal is to take the money we're generating off of it and pour it back into marketing to promote the event even more and more and more, to get more eyeballs on it, to help everybody be able to network with more people, and to be able to help all the people all around that are coming to this event. So thank you so much for your attentiveness. And next week, actually, let me share with you about the topic that we're going to have next week. So let me share a different screen with you here. So this is that article I was telling you about the IRR, but let me see if I can refresh my screen. Good. So next week, you probably have heard about LIBOR. So this is what a lot of these lenders are basing rates off of. LIBOR is actually going to be transitioning into SOFR, SOFR. And we're going to be talking about what that means for apartment syndication. We're talking about what is LIBOR, what is SOFR, how does it impact multifamily, and what you should be looking for in your loan documents to determine which one the lender is going to use, whether it's going to be SOFR or LIBOR. So make sure you go to this link. I'll type it into the chat box. It's actually not the one that you see on your screen. You could go to that one if you wanted to, but you can go to this link that I just typed in for you and register right now if you'd like. This is going to be happening on Thursday, May 14th next week, same time. And you can go to multifamilyinvestornation.com/MFIN webinar to register for the next one coming up. So even if this isn't the next one coming up, in 3 months from now, if you're watching this recording, you can go there and see what the next week's event is going to be, because we're trying to do these webinars every single week to be able to help you out as much as possible. So thank you so much for being here. Looking forward to seeing you at the MFIN Summit, and I hope you have a good rest of your day.